Welcome to the Bread Hour. I'm Finance King,
I'm JFL Lee.
and this week we got a banger for you. So we're gonna cover up the mini market segment. As you know, we go over what happened last week. We're gonna hit life and finance. We're gonna talk about love and finance, and then we're gonna get into the future of finance. And if we got some time at the end, I'm gonna throw in what to watch for next week. So you ready, big dog?
I'm always ready. Are you ready?
Yeah.
All right, let's get to it.
Finance guys in different spaces, but we live a life. So like I came up with this name, right?
Okay,
We're just gonna call it the bread aisle.
the bread eye.
Yeah.
All right, so explain.
All right. So like you know how everybody has like their brand of bread
Yeah.
that they buy,
Yeah.
but in order to get that brand of bread, you have to walk down the aisle.
Right.
Right. So you walk down the bread aisle, it's something for everyone, and that's what this is. But we're also gonna triple entendre. Don't even ask me how. Right. What do we call money?
Money's bread.
All right. What does God give us every day when He gives us instructions?
We get our daily bread. Okay.
Welcome to the bread aisle.
Okay.
So I'm gonna pop it off because the Fed really surprised me with some of the decisions that they made
Last week.
last week. I'm not gonna lie. I was
Okay.
shocked
Okay.
because they were like, I'm happy that they did it,
Mm-hmm.
but we talked about this. Like Jerome Powell has to. Banks failing, unfortunately,
It's part of the
is
deal.
kind of a part of the game,
Yeah.
right? But by him securing all the money
Mhm.
between the Fed, they had a joint, I don't know if you read it, they had a joint agreement, Treasury, the Fed, and the US government,
Yeah.
that they wanted to basically cover all deposits.
Right.
Or FDIC is the third party. But that's unheard of.
Mhm.
Like that's never happened
Ever.
right? But I like the stance that they took on not bailing the banks out because look, banks have a duty to the public,
Mm-hmm.
and the banking system is like the foundation of any economy. If people are losing money because of mismanagement or poor risk mitigation,
Mm-hmm.
you can't bail the people who were bad at their jobs.
Yeah.
You get what I'm saying?
Right.
But that had like a weird effect on the mortgage market.
So isn't that what that President Biden came out and said something like that, right?
Yeah.
We're not bailing them out. And for y'all who don't know, President Biden legislation and the Fed, the FOMC are two different things. So recently they haven't been
Seeing
in
eye to eye.
agreement,
Yeah.
but in this part they have. So President Biden came out and said, everybody who's in charge of this mess up or has a hand in this mess up, one, we're not bailing them out, and then two, they're gonna have some repercussions come in. And the Fed says we're not gonna bail them out,
But we'll cover their money.
but we'll cover their money. So how does that affect their interest rates?
Bro. All right.
mortgage
So
rates.
last week when SVB crashed, was that the 8th?
Mm-hmm.
Mortgage rates were at 7.5 on average, right? On a 30-year fix. This week, literally 7 days later, we're at like 6.5. And that's counterproductive for what Jerome Powell is trying to accomplish.
Yeah, a lower interest rates
Means
more buying.
more buying,
Yep.
right? Well, in the mortgage space, but he's trying to get inflation down. And one
Yeah.
of the biggest drivers of inflation is mortgages.
Right.
So as mortgages if they become cheaper, I don't know how long this is going to stand,
Mm-hmm.
right? Because naturally this was a like adverse action, basically. But I just think that, I don't know, man. It could be a trick. It could be like a false positive almost. Like,
Yeah. So do this for me. Break down why mortgage rates decreasing is counterproductive to Jerome Powell's agenda. Exactly how, so from my understanding, for their understanding.
okay. So ironically, the Fed rate and mortgage rates are not tied together.
Mm-hmm.
Residential mortgage rates, they're not tied together. But their mortgage rates are influenced by the Fed's, like his testimony.
Yeah.
But mortgage rates are more closely tied to bond rates.
Mm-hmm.
Bond rates are directly tied to what
to
the
the interest rate. Yeah,
what you understand what I'm saying?
Yeah.
So if they raise interest rates, bond rates go down, mortgage rates go up,
right.
and they have an
Vice
inverse
versa.
relationship, right?
Okay.
So bonds are the way that you liquidate or restrict the capital supply
Mm-hmm.
in any country, in any economy.
Yeah.
So if you're lowering interest rates, you're raising bond rates, which will allow, if there is, God forbid, another run on another bank, the banks aren't taking as much of an L.
Mm-hmm.
But that does not have a positive effect on his goal of getting inflation down to 2%.
Right.
And so I'm just curious to see, he's been at odds with Congress and Treasury. What's her, Janet Yellen?
Yeah.
Like
Senator Jenny Yellen.
like, so Treasury's a little bit different, man. Like, they're actually a government agency,
Mm-hmm.
right? And they're in charge of how the money is dispersed once it comes from the Fed. And they're in charge of the government bonds. But the bonds, when bonds start getting an influx, that's too dangerous for an investment environment, right? Like, bond rates moving,
they're not supposed to
move this fast,
right?
Like, so it's just like we could see an adverse effect happen, like inflation go from, what were we at, 6.5 last week? From 6.5, we could be back at 8, 9. You get what I'm saying? If mortgage rates continue to drop
down.
You get what I'm saying? And so it's just like, and then if you're a bank, and like we talked about Bank of America, if you're Bank of America and you got $1 trillion or 100 billion in bonds, and mortgage rates drop and bond rates go up,
mm-hmm.
what you gonna do? I'm liquidating everything.
Yeah,
like,
get that money.
Like, I'm getting
that money.
I'm getting my cash and putting it in something else. But right now, the way it's going, they kind of got to hold, because they have to hold through.
They got to get past. Yeah.
But if they have a chance to liquidate, now you got a fresh batch of capital
mm-hmm.
in the marketplace,
mm-hmm. which is
not good for what's happening right now.
Yeah.
So it's really interesting how I didn't see that coming. I'm gonna be real.
I think it's is the stereotype or the cliche thing to say is like a game of chess, but I honestly think this is like a bigger game. Not like chess is chess is small game compared to what this is. So, they got a big week coming up this week. I'll touch on that later, but we'll get an idea of where the Fed is headed based off of what happens this coming week.
Yeah, it's minutes week again, right?
Yeah. No. Meeting.
Oh, it's meeting.
Yeah, they got the meeting. Yeah. So
they talk about freezing rates, which means rates are going to mortgage rates are going
to. I don't know. I don't know if they're going to. I don't think so. This is my personal opinion. I don't think they're going to freeze. Europe just did a 50-point hike, and they're in worse conditions than we are. So we'll see. Man. We was on again, right? I don't want to get too far into what happened this week, but we were of assumption that it would have been a 50-point hike before the banks collapsed, and now
they're like, we can't hike it.
Yeah, now everything's up in the air. So we'll see.
If you was Jerome Powell, what'd you say? You say forget it and just.
If I'm Jerome Powell,
just continue, keep it moving, stay on course.
If I'm Jerome, I don't pause.
Bro, I'm not pausing.
I don't pause.
I would keep it coming. Y'all shouldn't have. But it's not fair though.
I don't pause, but I don't know. I'm not sure. I'm not sure, man. This is tough.
What I think the worst part about what could happen is we'll end up with like 5 banks. That's what I think the worst version of.
Was so like Bank of America, JP, I think Chase as well, and Schwab, they've been buying.
Yeah, and they've been giving everybody loans.
Yeah, they good. The big banks are good.
Well, we about to, that's a perfect segue, right? Into, you actually brought this to our
yeah. So there's an actor out there named Ryan Reynolds. I'm not really a fan of his acting work. What I do like is how he just became almost in the billionaire club. He's not actually a billionaire, but
He's close.
that much closer now
Yeah.
because there's a Ryan Reynolds commercial about Mint Mobile, and all of a sudden he owns a phone company, and Mint Mobile was acquired by T-Mobile for $1.35 billion with a B.
My
Um,
goodness.
so he bought that company, or he bought into that company in 2019. And what happened was the actual company or the founders of the company, they wanted him to be the spokesperson. So they gave him 25% stake in the company. He does. I've seen 2 or 3 commercials. You said
I've
you
only
only
seen
seen one,
Yeah.
and in a matter of 1 quarter since these commercials been popping off, the company is sold, and it sold for 1.35 billion, and now he gets about 400 to 500 million on his net worth. So I clap it up for
Yeah.
Ryan Reynolds.
That was
What a play!
that was some bread stacking right
What a
there.
play!
Jeez.
Brad Stacker. That's what that was.
Well,
We got another big sale to talk
yo,
about.
hey man, listen.
Another big sale,
Hey,
merger, acquisition, whatever
hey.
you want to call it.
I am excited about this actually.
Yeah,
'Cause I think it's very important for our culture to have this. But
yeah,
BET is getting ready to be for sale.
that is right. BT, if you didn't know, is in conversations for being sold, and 2, I've heard of 3 people or companies coming out and saying they want to potentially buy BT, but 2 of them are black owned or black people, Tyler Perry and Sean Puff Daddy Diddy
The
Combs.
third one is Robert Smith.
So Robert Smith is in the case now too.
But I think it's Robert Smith and Brother Love.
Oh, okay. Hey, listen, man. Whatever we do,
We
we
need
just
to get it.
just
We need
make
to
sure
get
we
it.
get it. We get it. And I wouldn't be mad if it ended up in Tyler Perry's hands.
I actually think it should be Tyler Perry.
It's
Like what is it, like 80% of their program?
yeah, it's about half Tyler Perry right now. So, um, I wouldn't be mad to see how this turns out. I think they should all just
I,
depart.
I was talking to Flo about this yesterday, right? And I was like, honestly, I would rather see all parties just everybody put up 10 million, 20 million. Let's just do this thing together.
Yeah,
Because the power of having and Diddy spoke about this in a post, like the power of having a black owned media company,
Mm-hmm.
what it represents in the space is like I saw the CEO of BET say this. He was like, BET is black managed and ran.
Yeah,
But I still feel like at the end of the day, they got to answer to Paramount's board of directors.
right.
If you understand business, you understand that BET is a subsidiary of a much larger thing.
Right.
And so at the end of the day, it's based on share price and what their contribution to the bottom line is.
Yep.
And as we can see in our culture, the information that they're peddling isn't productive for
us
for
personally.
us,
Yeah.
right?
Yeah.
It might be entertaining.
Yep.
It might do numbers and go viral and all of that stuff. And it might give us the representation we need in the Hollywood and entertainment industry.
Mm-hmm.
But from a business perspective, us owning the entity and not having to answer to a board of directors or shareholders or those types of people and allow us to, Tyler Perry's doing his thing, but I still think he has to, I don't think he get as radical as he would if he owned
it.
You
He
get
didn't
what I'm
have to
saying?
answer to anybody.
If he didn't have to answer, he didn't have to get he could probably deliver a much more concise message to our people.
Yeah.
Right? Even like do you remember when BET had like a news segment? It was a long time ago. I'm aging myself.
I'm not
It was
sure.
like late.
I think
it was like late news.
I'm not sure.
But like even some of the programming, like I think about what BET was for us
When
before
we was growing up,
before Viacom bought it, and I'm not mad. Like I'm gonna throw something else in. I'm calling Audible real quick, but I'm never mad at black people building businesses and then selling them.
Yeah.
Right? Because that's the end. That's the end goal.
It's really only 2 ways, and this is like economics 101. It's really only 2 ways to exit a business, right? You either sell it
Or you pass it
or
down to your kids.
you pass it down, right? What's the next part you got to say? And if you my man, like I think you my man.
You talking about Mike?
Yeah. Yo, shout out to Mike. You know,
shout out to Mike, bro.
He's a certified bread stacker. Certified bread stacker. But this next play,
bro.
And pardon me, because this is not on our
production sheet.
Yeah, but it needs to be talked about. So I'm not exactly sure the numbers.
150 he bought him for. He bought his majority for $150 million.
He bought his majority.
I'm a verify. We got.
I believe it's 180. Right. He bought his majority stake in the Charlotte Bobcats at the time for 175, and now he's selling it for.
I mean, he's going to get at least $1 billion, maybe $1.5 billion. So
he pretty much flipped his
100 times his
yeah,
like 100 times his money.
Easy. No, 2, 3, 4, 500 times his money.
But think about but that's what I'm saying. Like, all right, we could be mad that we're losing the only black owner in the NBA, right? All right, whatever.
But he came up.
He's stacking that bread. What you mean? Like,
it's no. I don't see anything wrong with if your exit strategy is perfect. I don't see what's wrong with that. I've closed 2 companies now. One of them has allowed me to have the cushion to roll over and start a new career.
Yeah.
So
I mean, I'm in real estate. I purchase when I do my own investments. When I'm analyzing a property, I'm thinking about the exit in mind. Yeah. So in like real estate, we have a statement: you make your money when you buy the house. Mm-hmm. So, but in order for me to understand what I should pay for it, I have to know what I can either sell it for or get it refinanced for.
Yeah.
So true. I'm never mad at somebody cashing out.
This is true. I think having an exit strategy before entering into anything is perfect. You know, it's like the ideal way.
Like even the Lakers, like a lot of people don't know this. The Lakers had to sell a piece of the Buss family had to sell a piece of the Lakers in order to build Staples.
Yeah.
So
selling is not a bad thing, right?
No, it's not.
So basically, the moral of the story is selling is not a bad thing.
I just think that we need that mindset. Like, look, black owned is always great, right? Mm-hmm. But black wealth is more powerful than black owned. Yeah. You get what I'm saying? So there's only 3 ways to build wealth in this country.
Right.
You own a business or and operate or build a business, real estate, or the stock market.
Pretty much.
It's pretty much the only 3 ways outside of inheriting it
and being an athlete.
Or winning the lottery.
Yeah.
So, which is like being an athlete. So I don't know, man. I just think that it's I think we should tip our hat to the bread stackers out there who are out here making plays.
Shout out to Diddy. Shout out to Tyler Perry. Big shout outs to Robert Smith.
Well, he's a GOAT.
Shout out to Mike. And shout out to Ryan Reynolds for his bread.
Yeah, shout out to Ryan Reynolds, man. That was a good play, man.
Yeah.
And I brought that up though, I know we're getting ready to change topics, but I bet a bank financed that 1.3.
Oh yeah.
100%.
Oh yeah.
Or somebody they gave some stock.
Yeah. I wonder why T-Mobile bought that company.
Well, they own Metro.
Who owns Boost? Sprint.
Sprint owns Boost. No, but T-Mobile owns Sprint.
Oh yeah. So now we see the play. We see the play. So T-Mobile wants market share across the board, total market share across different companies. As long as they own the company, they own the market share.
Kind of kick them Verizon ass
right. That's a good strategy, but I will hold off on that because the cell towers that Verizon use.
Well, I know you're very Verizon.
Yeah, let's hold off on that. But T-Mobile is doing.
That was a good play, man. Shout out to Ryan Reynolds, man. Yeah,
you got your mind. I want to see what he does.
Or you think he put up any bread for that? Or he just his name and likeness?
Name and likeness.
Yo, celebrities, y'all should. That is a masterclass.
I'll give you one better. We getting off topic a little bit, but I give you one better. Matthew McConaughey.
What company?
Salesforce. Matthew McConaughey is he's not he's a
Salesforce just sold for like, but it just did. I just had
no. They didn't sell. They did
Did they raise?
yeah.
Oh,
Yeah, but check this. Matthew McConaughey, he's not even a spokesperson because he doesn't speak out for Salesforce publicly. He's like they hired him for like morale. Matthew McConaughey gets paid $10 million a year to be on Salesforce staff, and he gives a speech at their annual conference every year. 10 mil.
I used to say George Clooney had the best play ever, but I think I'm gonna give it to Ryan Reynolds.
Man, that was nasty, man. 4 years, about 500% on your money, and
What money?
you only did 2 commercials.
All he had
3
to do was show his
commercials.
face. He got 25% at one
Yeah,
point.
that was nasty.
Yeah,
That was nasty.
that's some bread stacking right there.
Shout out to Ryan Reynolds.
Oh man,
Let's transition to
real life.
right? Real life.
How
Now,
do we get to the points that we talk about?
pretty much, right? So, in real life, there's a misunderstanding or a misconception about life insurance, right? Now, I do want to say I am a licensed financial advisor. I am not going to tell you any strategies about life insurance. I'm just going to try to clear up some misconceptions that goes on with life insurance today. So first, we're going to start with index universal life. Everyone's favorite, right? We're going to start with the index universal life. Is your favorite?
Oh, easily. Not even close.
Oh, I'm glad.
Even.
This is going to be a good conversation. Index universal life started out in about the late 1980s to the 1990s. It became popular late 1990s and the 2000s. The reason why it became popular is because a lot of the people who were wealthy were making their money from the stock market, like you mentioned earlier. So in order to compete for the dollars, the insurance companies made a product that could have a potential growth similar to what the stock market could do so that people can continue to put money in insurance companies. Thus, the index universal life was born. So the index universal life, these are the pros. They're tax deferred growth. That's pretty much most
most insurance,
most products, right? But they're tax deferred growth. They have market linked returns, and you also get some protection on the downside. So, for example,
you have a floor rate, right?
Yeah. So for example, the stock market, let's take this year or last year, the stock market is down. Your life insurance policy, well, your index universal life insurance policy wouldn't actually be withdrawn. Like the money wouldn't be taken because you're in a deficit, right? So just keep that in mind. You have a flexible premium, which can be considered a pro. And you also have a death benefit. Now that's typical for all life insurance, right? So here are some of the cons of a index universal life. It's a complex product. That's first and foremost. But if you have someone who can explain it to you, then that con can be, turned into maybe a benefit. But not everybody can explain the index universal life, and this is why this is the segment. Your gains are limited. So they give you whatever that rate of return is.
So is it a ceiling and a
Yes. So it's a ceiling, it's a ceiling and a floor.
Okay.
Meanwhile, the actual insurance company can very well be making way more than a ceiling.
Loans.
Right? So that's that. There are fees to operate the index universal life because there is someone who is actively managing your portfolio on the stock side. So you have to pay that person. And there's also a risk of loss. For example, again, if the stock market crashes or whatever, your death benefit and your policy will be affected, right? Because if the stock market isn't growing as predicted, then of course the expected in cash face value isn't going to be the same. So there is a potential for loss. And the premium on the COI can increase. Now, and this is my biggest thing right here that no one ever talks about when it comes to index universal life. COI stands for cost of insurance. because your premium is flexible and it's considered a benefit. So, for example, I'm 33. If next year I didn't, let's say I was comfortable with paying $1,000 a year this year for my life insurance policy, and next
For the
year
whole year or a month?
for the whole year, either or, whole year or a month. Let's go with a month. I was comfortable paying $1,000 a month for my policy, and next year, and you know what? I don't want to pay $1,000. I want to pay 500. That's fine. That this policy allows me to do that. But because go
I'm
ahead.
sorry, I don't mean to
No, go ahead.
interrupt. But does the death benefit decrease if I decrease my premium?
So it's affected. The death
Oh.
benefit isn't necessarily decreased, but the cash value will be decreased.
Or
But
your contribution to the cash will be
yeah, so
okay,
yeah,
gotcha.
the rate of
Your rate of return will be okay,
will
gotcha.
be decreased. But here's the thing: because it's flexible on your side, it's also flexible on the insurance side, right? The company side. So COI stands for cost of insurance, which means how much does it cost an insurance company to insure me, right?
Mm-hmm.
Because now you've had your license, so you can understand this, but I'll break it down for all of you or some of you who don't understand. The younger you are, the cheaper it is to get insurance. Why?
Mm-hmm.
Because it's the less likely you will die today, right? It's all about if you die today. So if you're 96 years old, it's way more likely that you will die today than it is if you are 6 years old. You get it? So as long as life insurance will never be cheaper than it is today, point blank, period.
No matter what policy.
No matter what policy. Okay. So the older you get, the more potential that you have to get health risk, which increases the cost, and of course, the closer you get to death, the more it costs the insurance to insure you.
And your risk.
And your risk,
the
right.
risk of them paying you out.
So they'll increase the premiums to match the insurance. So what happens is, and this is the part that no one talks about. So what happens is there's a yield curve when your premium goes like this, right?
Mm-hmm.
But your cash value goes like this.
Because of the rate of growth.
Okay. So that's what everyone talks about.
Of course.
Your cash value goes up here, your premium's up here.
Nobody talks about the expense.
But nobody talks about the expense. So what happens when you are 60 years old? You see that you have a cash value of, let's say, $2 million, right?
Mm-hmm.
And your COI, your cost of insurance, is $5,000 per month to maintain. But you're about to retire, which means your income is cut. What do you do to that insurance plan?
Probably cancel it.
You probably cancel it.
Yeah.
All right. So check this out. So you cancel your insurance plan, which means the cash value goes like this, right?
Mm-hmm.
And then you start living off of it.
Or you lower your death benefit.
Yeah. Which is, again, brings the yield down, turns into a bell curve.
Yeah.
And you start withdrawing from it because you're retired, right? So it brings it down faster. Meanwhile, your premium is going up. So there's a point in which it doesn't make sense to keep the policy no more because you're not getting as much because the premium is going up and the face value is going down. So when that happens, what happens?
You're losing money now.
You're losing money. So
you're actually becoming a bank, and
yeah,
what the banks are going, but the banks are going through
right now.
Yeah.
So what do? You get out of that situation. You cancel your life insurance policy, right? You would.
I don't recommend canceling.
I don't. Okay, I'm not. All right. You're right. I'm not saying that. I'm recommending this. I'm saying that in a situation like this, when it's way too expensive, this is what people do.
They do this.
They cancel the insurance because it's too expensive. They're not seeing the returns that they used to. So let me cancel the insurance, get my face value. You get your face value or your cash value. You take it all out because you're like, okay, cool. Now
is that taxable?
It's taxed. So you defer the taxes. So now you get taxed. And then you say, okay, if a smart person would at least say, all right, let me go get term. but now you're paying
I was going to say,
astronomical
but
numbers.
if depending on how old you are when you do that, that term is going to be
Astronomical.
brolic.
So you're stuck between a rock and a hard place, pretty much.
Let me ask you this:
Mhm.
What if you take that? Well, I don't know if you can do. I know you can do it in whole life, but what if my cash value? I'm doing my 1-2 thing
Mhm.
out of the. I'm borrowing against it
Mhm.
constantly,
Yeah,
creating
other streams of income
streams of income
and
off
putting
of
it back.
that. Yeah, putting it back.
That's perfectly fine.
Does that offset
It
what you're talking about?
if you do the calculations correctly, it could offset, but again, you're still paying an increased premium.
So, what do you recommend someone do to?
So again, I'm not gonna recommend
Oh, my
anything
fault.
right now,
Hey, you can't recommend
but
that.
what I would just tell you is there's other products out there. So for everyone, if your purpose for using this policy is to have a infinite banking solution,
IUL is probably not the product. You know, it's probably not the product.
okay. So you don't think it's the product? I
I think it's
think
too expensive to be a.
I,
That's just very personal. I love
yeah,
IUL, right?
yeah.
But I love IUL because it gives me mutual fund style returns
Mm-hmm.
with a death benefit attached, right?
Right.
I think if you want to do infinite banking and using it as a lending source, a traditional whole life will serve the same purpose.
This is why this is my guy. so at this point, someone says, okay, you give me all this uh problem,
Yeah.
what is the solution to a problem? Again, I'm not going to give you a solution, but there are other products, and I stress for everyone to do your own research and figure out which products fit for you,
what you want.
because a whole life policy does very similar to what an index can do. Now you don't have
You don't have the sexy returns.
a sexy return, right? You don't have that. You have a guaranteed fixed interest rate. So no matter what happens in the market, while index may be losing money right now, a whole life is still making
That's
money.
what I'm saying.
So you have stable premiums, which means if they said my premium is $500 a month today, it will be $500 a month until I turn 100 years old. It's not callable, which means as long as I'm paying a premium, the policy has to be honored, right? It's a two-sided contract. I'm paying, they have to honor. They have to honor what the contract says. So that's what make it two sides. Whereas an index universal can be called.
Really, I didn't know that.
It depends on the company, make sure you read the fine print, but some indexes can be
I
called.
did not know that.
And then lastly, which I didn't know, but whole life gives the policy owners the option to maybe receive dividends depending on which company it is. So again, one of the cons, I'm gonna be fair, one of the cons of whole life is a lower return. So if you want the sexier option, index universal has the potential to give you the higher growth rate.
I'm about to hit you with it.
I'm with it. Let's do it.
What do you say to buy term invest the difference?
Again, that's a strategy, but
it's an
option.
Okay.
It's an option.
You're not against it.
I'm not against it.
Okay.
So
I don't want. Do you want to explain?
Yeah. So I'll try to do the best I can. So buy term invest the difference means you are buying a term policy which is not permanent. So you're buying a term policy, whereas if a term policy is maybe $100 for X amount of money, the same X amount of money in death benefit you get for a whole life or IUL may be $400 or $500. So, and what he's saying is you buy the term for $100, at least you're covered. And then you take that $400 and what you would have paid for the other type of policy, and you invest it yourself or with a financial advisor or whatever. I'm not saying me because I wouldn't do that, but you invest it, and then you have your return on that side as well. Now, here's what I will say that nobody told me before I started working where I work at now. There's a thing called a convertible term policy. Now, what that means is if you don't have the option to buy whole life right now, you could get term. And in that term policy, if you get it for a minimum of 10 years, you can have the option to convert it into a whole life policy.
I've never heard of that. I learned something today.
Yes. So instead of buy term, invest the difference, I would just tell someone to buy convertible term.
I did not know that.
Yeah. So that's an option. So that's what I wanted to present in life and finance. I want everyone to make sure y'all do your own due diligence. If you don't have life insurance, I would highly suggest getting life insurance. If you don't have disability insurance, I would highly suggest getting disability insurance. And if you don't have umbrella coverage, I would highly suggest getting umbrella coverage. We can break that down a little later. But before I turn it over to you, I do want to give this example to put a perspective in people's mind, right? So you have a phone.
Yeah.
You have a apartment.
Yeah.
You have a car.
Yeah.
You have a body.
A good one.
Yeah. All of those are insured.
Yes.
All right. So if you don't mind, how much do you pay in car insurance? Or you don't
200.
even 200?
Yeah.
Okay. If something was to happen to that car,
What's my deductible?
No. If something was to happen to that car, the insurance take care of
Yeah.
the expenses and everything.
Yeah.
You don't have to worry about anything.
No.
Okay. Health insurance. If something happens, obviously, there's a lot to go on, but
Yeah, but for the most part, I'm covered.
Yeah. Okay, you're covered. And if you break your phone, you can
Yes.
go get insurance. Okay. So you said you pay $200 for your car insurance. So
I actually pay $200 for life insurance too.
Perfect. So you have life insurance, yes. But for those who act as if you are someone who doesn't have life insurance, you pay $200 for your car insurance. Do you think that your life is more valuable than your car?
Absolutely.
Would you consider paying at least $200 for life insurance if you pay $200 to insure your car?
Is this me as a informed individual?
This is you as
this is me 22, 23?
This is you as 33, but you don't know what you know.
Yeah. Yes.
You would at least consider it.
I would at least consider it.
That's all I gotta ask for. If you insure your car, you insure your house, you insure your phone, why not insure your life?
You know my philosophy about life insurance, which is going to segue into what I'm saying, is like, if it's valuable, it should be protected. Yeah. And there's nothing more valuable than your life, especially in our community. Our community, we have a lot of potential of catastrophic event points, right? There's just a lot. Like, I'm just be real.
Yeah, no,
right?
That's a fact.
And so if you're a breadwinner, male or female, and there are people who depend on you and your ability to earn an income, that in itself should be why you're insured.
Exactly.
You get what I'm saying? Yeah. But I think that I feel like I do. My segment is going to be about whether you should buy the house you live in or buy an investment property first, right?
Okay.
I don't think you should do either if you don't have life insurance.
I agree.
That's just me being 100% real. You shouldn't play in any other game.
I agree.
If you don't have life insurance.
I got one last thing to say, and then I'll turn it over to you. Bringing people on as clients, the initial thing that we do is assess in 4 categories. We assess assets, liability, cash flow, protection. If they do not have protection, none of the other things matter. So in 100 times out of 100,
most people don't have it.
We start at protection. Yeah. But go ahead. That's all.
Shoot, I'll even drop another one. If every black person, this is a PSA. If every black person in America had life insurance, they would stop killing us.
For a fact.
Point blank period.
For a fact.
Point blank period.
A fact.
If we all had life insurance, we wouldn't worry about no police.
Nope.
Because you don't think a company like Northwestern Mutual, who would have to pay that, wouldn't be suing whatever PD?
This is a fact. A fact. I want to go on record and say, I want to go on record.
I'm sorry, I had to get that off.
At least before COVID, insurance companies ran the country. I'll say at least before COVID.
What they say goes. They are the biggest capital provider to all
America.
In all seriousness.
So if you want something done, if you want something done, not saying you, but saying the people, if an insurance company says, look, let's 2 or 3 of us big dogs get together and pressure legislation.
Oh, George Floyd's Policing Act would be enforced.
It'll get done.
Right now.
Right now. So if he said to everyone, I would say if 75% of all eligible black people,
40% of all eligible black people
got insurance,
got life insurance,
yo,
we would not have
stop
the problem.
touching them.
Leave them alone.
Stop. Matter of fact, police their hood. Redlining might actually.
Bro, there would be so many different.
Yeah, man.
I could go down a long. But again, this takes me to what I'm talking about because we've been tricked.
Hoodwinked. Bamboozled.
And I'm going to give y'all some real sauce right now. The American dream is a lie.
Uh-oh.
They told us to go to school, get a job, buy a house, live in that house, send our kids to school, do all those things, right?
Yep.
All of those things incur debt. Everything I just named, right?
Yep.
Not one of those things is an income generator passively.
Nope.
I am a person who believes everyone should own real estate. You don't necessarily have to own the house you live in. But I want to be careful with that message because it starts with owning real estate. So when we start there, that is the starting point.
Yeah.
There is no better wealth generator in this country
than real estate.
You can create opportunities and it's transferable. You can write off depreciation. You can do all of these. There's so many benefits of owning real estate, whether it's your principal resident or an investment property. So the thing is with your principal resident, your wealth generation, where it comes through equity. It doesn't come from, unless you house hack.
Yeah.
And house hacking is I don't want to say short term, but it's a great entry point into building a real estate portfolio. But it's you can't house hack your way to wealth.
Yeah.
Right. You eventually got to start investing in some wholly passive assets.
Right.
And so I just feel like they didn't promote investing in real estate the way we promote buying the house we live in, right? Everybody wants that dream house.
Well, again, the country's ran by banks. So
yeah. So from a bank's perspective, right?
They want you to buy.
They want you to buy the house. And I think it's really about intention, right? Again, you need to have some level of passive income. It doesn't have to be real estate. If it's not going to be real estate, let it be the stock market, right? Let it be some version of passive income that allows you to cover your debt service, right?
Yeah.
But I look at it like, buying investment real estate is such a powerful way. Like you really could own 10 houses and live in an apartment.
You could.
You get what I'm saying?
Yeah.
And
that's what you wanted to do.
And you're living in that apartment for free because your 10 houses generate
enough income,
as opposed to a person who went and bought that $400,000, $500,000 house to, you live in it.
Yeah.
You should own land,
right,
in some capacity, but you live in this. But at the end of the day, it's a liability. It costs you money every month.
It is.
And so if you don't have some level of investment to offset that debt, every month, then, and we talked about this in the first episode, you know, a mortgage is not a QM mortgage, right?
Yeah.
That's not a loan on the real estate.
It's a loan on the income.
It's a loan on the income. So primaries are cool. You know what I mean? It's definitely a. Remember, I told you this. I told you this a while ago. If you can qualify for a mortgage, a conventional mortgage, 5% or 20% down, you are in a very healthy financial space, because conventional mortgages have a little stricter guidelines. They're a little bit cheaper on the insurance, mortgage insurance, points tip, and they're not gonna allow you to over leverage your income.
Yeah.
So if you can afford to buy the house you want with a conventional mortgage, you're in a very strong space, a very healthy financial space.
Right.
FHA, I wouldn't say so much, because FHA is designed for the person who's not in that position to buy a property.
Right.
And then VA, which I personally believe, you heard me tell,
Yeah.
is the most powerful loan product in the QM space. That's entirely different. If you're a veteran and you haven't used your VA, you are missing out on a massive opportunity to generate wealth for yourself, because VA provides 100% financing, meaning you come to that table and buy yourself some real estate with no money out of your pocket. And if you're disabled, you don't have a VA funding fee, which is their upfront version of mortgage insurance.
Right.
So now you're really truly 100%. Right. That's why Maryland doesn't see the economic downturns in the housing market, because there's so many vets here.
Yeah.
Right.
Right.
And then you have another loan product called USDA. And USDA is a very powerful loan product, but it's designed for people to build in rural spaces. And, you know, again, I could go into a deep, you know, maybe we'll do it on when we launch our Patreon. Patreon's coming soon. I'll talk about how the benefits of using USDA in farmland and how powerful that really is.
It's funny you say that, because when you talked about real estate being the best the best wealth generator, you know, and my response or my add to that piece of the conversation was going to say was going to be that the biggest tax breaks are for real estate and for farmland. So
the tax benefits of owning real estate, again, principal or investment, nothing compares. And what you're able to leverage, and you're able to leverage real estate a little bit more than equities or businesses. It's a very powerful thing.
Yeah.
I just think that you need to be intentional when I always talk about this, like intention, like everyone doesn't have to buy that dream house. You get what I'm saying? You can live like me. I'm a penthouse apartment kind of guy, right?
Yeah.
And I think that's going to be regardless if I have family, kids, wife. I'm always going to want
the condo
vibe over the big mansion vibe.
Yeah.
But again, you can live that way and own real estate, right? You can live that way and create these situations and create transferable wealth for your kids. So I just wanted to really make sure that we understand, like, you don't have to own the house that you live in, but you should own real estate.
Real quick before we switch topics, what do you say about the opportunity to maybe buy land
and build your own
that is just, you know, is nowhere, like, for example, we're in Maryland, but let's say we come across an opportunity to buy maybe a couple acres of land in Alabama or something. What do you say about that?
I would just say know what the land can be used for.
Okay.
Once you understand what the land can be used for, buy that.
All right.
But You don't just blindly buy land, because land in its raw state
Can be a
can be
liability.
a huge liability.
Yeah.
And so land is only as valuable as what you can put on it.
Right.
So first it's where it is,
Mm-hmm.
and then it's what can I do with it.
Right.
So if I have an opportunity to buy 10 acres that I can land lease to, I don't know, Toll Brothers to,
Oh yeah. We good, right?
we good.
We
You get what I'm
golden. We
saying?
golden.
Yeah, absolutely. I'm going to buy that
All
land.
right.
But if I'm buying just forest conservation to walk, maybe I build a campsite. Maybe, I don't know. Like, it's about land. It's about use,
Yeah.
more so than just hold. Unless, I will say this, you can just park your money in the land. You see
Okay.
a lot of the like
Okay.
super wealthy do that.
Bill Gates.
Bill Gates, Oprah, Jeff Bezos, Richard Branson owns that island in Hawaii,
Mm-hmm.
or owns a piece of a island in Hawaii.
He's
Like,
a really bad owner out here.
he's terrible,
yeah.
but well, that's a different conversation. But you can kind of, you need to
throw some
throw some bread, offset some taxes,
Yeah. Do it.
do it.
Okay. I
But
got you.
for the most part, it's really about how can I use the land
Yeah.
that matters. But land is actually the best purchase you can make in this market right now. So
Yeah, maybe we'll have a deep dive into
yeah, I like land, man. I hollered at one of my OGs, he's a developer. He gave me some super game about
I'm
about
with it.
land today.
I'm with
So
Yeah,
definitely.
I'm with it. Let's put something together so we can
Yeah, I'm with that.
dig deeper into that, give it to the people.
All right, we're getting ready to take a quick intermission. We'll be right back with you with our phase 2 of this episode of the Bread Hour.
On Saturday afternoon, I get to chill with my man. I get a break from the family, break from the kids. What better way to chill than with a quick glass of Remy Martin?
Team up for excellence.
Team up for excellence. Make sure y'all drink responsibly.
And we're back. This is my personal favorite segment because y'all know me. I'm going to be metamorphosized into Loverboy Lee. Well, in this segment, we like to talk about relationships and finance because we feel like that's an extremely important part of life. We actually asked a couple of our really close friends, some of what they thought we should ask and what questions they had. So the first question, my dear friend Finance King.
So the first question is, do you need your partner to be involved in your business? Now, this is obviously assuming you're an entrepreneur.
It would be ideal.
It would be ideal.
It would be ideal.
It would be ideal.
I don't think entrepreneurship is for everyone, but I do think there needs to be a level of continuity when it comes to how money is made and how you grow it. But if you're an entrepreneur, you either need a partner that's going to help you build or get out your way.
I like the fact that you said you either need a partner that's going to help you build or get out your way, right? I like that as those two avenues because, we've had multiple relationships. I've been an entrepreneur and I've had a job. And what I will say about being an entrepreneur is that if you have someone that is involved with the business, I think it depends on your personality too. Because me, you could be involved, but I don't want you too involved. Because then you start telling me, what you think is best, what's this, what's that, which is fine. I like the opinion, but for me, I just like the opinion. I like the insight. I think that's the most involved. Unless you want to handle like things that I deem worthy of you handling, maybe like back office stuff or
you better tread lightly with that deemed you.
No, I'm not saying like that. I mean like if you want to handle like administration stuff or back office stuff or like monitor systems and different things like that. Things that I
aren't good at.
I either aren't good at or
don't want to
care less to do,
Yeah.
or maybe because I'm efficient Keem. So maybe if you handle this, I could be more efficient at actually running the business and growing the business instead of using time to do this. So I like that part. Or just stay out my way because the business is gonna get ran regardless.
Yeah, I think that for me, there's a level of trust. You can't like turn into an op where I don't want to share
Exactly.
what I'm doing with you, right? I need to constantly be able to trust that you understand my vision.
Mm-hmm.
It's especially in my case because I'm speaking specifically to me, not but
Yeah.
like I'm building a very specific type of thing that
Mm-hmm.
I've spent years studying the ins and outs of.
Mm-hmm.
And so there has to be a level of trust that I have to I always welcome criticism, but it has to be productive,
Right.
right? I don't ever try to be perfect.
Mm-hmm.
But I think I think it's really important that there's even if without like even if you're not an entrepreneur, right? How you grow your money, there has to be collaboration there.
Mm-hmm.
Or somebody has to be the sole person responsible, right?
Yeah.
So like I have aunts and uncles, and it's not about who makes more money or anything like that. That's not the conversation I'm having. But I have an aunt who's a doctor and an uncle who's an accountant.
Mm-hmm.
Who do you think
The
is
accountant's
the accountant? You get what
handling
I'm
it. Yeah.
saying?
Yeah.
And then there's other scenarios where I have an aunt who's a doctor and an uncle who's a real estate developer.
Mm-hmm.
He probably doesn't make as many of his deals. He's probably going to holler at his wife.
Yeah.
Like, hey, what do you think about this? What do you think I should take this? Because there's a level of trust that they've built through their relationship over
Mm-hmm.
over a span of time. So I just think that it really, again, like you said, is personality. I do think there has to be a level of understanding and continuity when you talk relationships and finance, and if you're an entrepreneur, your business,
Yeah.
and who your partner is, because they say, hey man, most important decision you can make in your life when it comes to money is who you choose to spend your life with.
Yeah.
So I mean, like if you got somebody that don't care about how you make your money and don't care about the energy and effort that you put into it, they just care about how much you can spend, that's going to be
That's gonna take a toll.
that's
It's
going to
gonna
take a
take a
toll on
toll.
you.
Yeah. What I will say that is the total opposite of this question, and I would say that's probably not um allowable or not suggested is that you're that person that entrepreneur who doesn't share at
Oh
all.
no,
Like,
you can't do
you
that.
know what I'm saying?
No.
Yeah. So I think that's
You
totally
either
out the
have to
question. It has to
share.
be some line
Yeah.
and when of sharing.
Yo, this next question.
Yeah.
How do individuals balance their financial goals with their romantic relationships, especially when it comes to differing values and priorities around money?
Woo!
Fam.
Woo!
Fam.
Say that again for the people in the back.
How can individuals balance their financial goals with their romantic relationships, especially when it comes to differing values and priorities around money? I have lived that in real life.
Yeah. And because you have, I'll go first. So I think, in some aspects, this could tie into the previous question about, entrepreneurship and all of that. But just for basic relationship, you know, question around relationship and not really business part, I think financial goals or the money conversation, I'll just say that. I think the money conversation for those people who are in serious relationships, married, fiancés, or engaged, all of those people, I think that should be a top 5 conversation.
I think it should be two.
Yeah, I mean, depending on
I think God, then
yeah. You know
what's up with
what?
this money?
You know what? I'll say top 3. I'll say top 3, and because you said God, so religion, money, children, right?
In whatever order.
And in whatever order. I think it should be that because if your financial priorities are way different, and between men and women, it usually is, on some degree. Women like to be a little more lavish. Men could be a little more frugal, but women are more responsible.
Always.
Men are more irresponsible.
Yeah.
So if you guys play on that and
Mhm.
not really hold each other accountable or stick to the financial goal that you have set out in the beginning, things can get derailed very quickly, especially if you're sharing accounts.
Hey, I'm gonna take it. I'm gonna take it.
A
I'm gonna
step
go ahead
further.
and let's go ahead and
Okay.
jump down that one. How do you feel about sharing accounts? Do you think it's necessary, or you think everybody should have their own?
I don't think it's necessary. I'm not opposed to it, but I am opposed to only shared accounts. So I
Okay.
I think it makes sense for every household to have three. You have
Individual
your separate, and
household.
then a shared one. And maybe the shared one is the ones that come with the bills. And that just because it's a shared account doesn't mean you splitting 50-50 or whatever.
You
If
know
the
that's where I was about to
Yeah,
go,
if the
right?
man is going to pay all the bills from that account. At least the wife can see that the bills are getting paid.
Well, how do you feel about
The
50-50
50-50.
or
So this is the stipulations that not the stipulations. This is the conversation that I had when my girl first came over here,
mm-hmm.
and obviously she came to me, so I had the house, the apartment at the time, and I was already paying the bills. So in my mind is like, not first of all, I don't want you paying the bills, but I'm not going to ask you to pay any bills that I'm already paying anyway.
Mm-hmm.
So all of the shared bills are covered.
Mm-hmm.
All of that is covered. What you do with your money, you do with your money. Any bill that don't affect me, that's on you, bro. So that's how I had handle it. And it's changed a little bit. Of course, I paid for some things, and
Yeah.
and I pay some bills and all of that, but essentially that was the conversation that we had, and she agreed to it, and she thought it was fair. So
So I think that
because your conversation went a whole different way. So
I don't even know if
so
I'm gonna
let's
talk about my conversation, but
let's get your perspective.
um so I was in a scenario where the person I was dealing with they didn't need me financially in any capacity,
Okay.
right? But this goes back to my conversation about last week about when we talked about love and business, right? Where I wasn't necessarily there wasn't a level of equal when it came to like income at the time.
Mm-hmm.
So I was in a building the business to even to the point that it is now, right?
Mm-hmm.
Like I had to get here.
Right.
So I was in a space where I was like, I can't really afford to pick up your bills,
Right.
right? Doesn't mean I love you any less, but I'm not here for the things that you have. But that was more emotional. But this is how I came up with love don't pay the bills, bro. The bills come every month. Like I love this girl, so I'm blue in the face. But until I've reached a point where I could afford to really be that provider in that
Mm-hmm.
capacity, it would the restraint.
Yeah.
And so I learned a really valuable lesson there. And I remember, right, wrong, or indifferent, I just remember asking her this question where I was like, yo, is you gonna be an asset or another bill? Because I really don't need another bill, right? I probably delivered that in like the worst way, but what I was trying to say is kind of a part like I was looking for a partner to help me build
Build
out
your
my
business.
vision,
Yeah.
and I didn't have a willing participant there. She was like, I don't want to be no entrepreneur. I went to
Right.
college, got a
Right.
degree.
Right.
I'm doing what I'm doing.
And you essentially asked it. are you gonna be in the gym shooting with me?
Yeah, and she was like, nah, like
Nah,
go get your jump shot right.
because I got
Because I got mine. I got mine. I got my
Yeah.
situation. And so I had to realize, but for me as a individual, you know me, I'm a warrior. So I'm like,
Oh
bet.
no.
I'm gonna
Okay.
show you, right?
Okay.
But that changed the dynamic of how I was building my business. Now I'm building my business to prove to her that I
Right.
can earn the income and create the income
Right.
to support her lifestyle in whatever capacity, right?
Mm-hmm.
Whatever it was. Again, she did not need me in any way.
Yeah.
So I'm really playing catch up. And then when I caught up, well, then, things
Chanel
changed.
bags every
Yeah, we
week if
said
you want
it's
to,
back
right?
popping. Like, you get what I'm saying? When I got myself in the position, but the stress of getting there for the both of us,
Yeah.
ultimately, I believe, was ultimately the demise of our relationship. But it was so valuable because our priorities around money were very, very, very different,
Mm-hmm.
right?
Mm-hmm.
Like, me,
Right.
I am impulsive to a fault, right?
Right.
And as I got older, I had to realize that. But my partner at that time she wasn't impulsive. Everything was orchestrated and
Yeah.
calculated and planned. And
Mm-hmm.
I'm just out here, hey, we just made $10,000.
Let's do something.
Let's do something. She's looking at me like, fam. I'll never forget. I'll give her this credit, man. I ain't going to say her name, but I'll give her this credit. I had a play for like 40, 45, right?
Yeah.
This is like when we first started dating. And I'm,
Feeling good?
I'm feeling good.
Feeling good. Big money Lee.
Big money Leo. Like, you get what I'm saying? What you want? You want this? Let's get it. You want to go eat $500 dinners every Friday? Let's go do that. Right? And I remember her looking at me and going, I don't want to see you broke in 6 months. And I'll be damned, Hakeem, if I wasn't flat broke. And which goes back to what I talked about last week again. I always speak from a real place.
Mm-hmm.
I don't speak in speculation when we have these types of conversations. That's the moments where I learned, like, hold up. I don't forgot that I run a business.
Yeah.
Like I ain't doing the work. I'm so focused on making sure she knows that I can
trick off
and keep up. And it's to no fault of her own. That's my own ego pandering.
Right.
But because our priorities were different, it didn't fit.
Yeah.
You get what I'm saying? And so I think it's like the most important thing is like being steadfast and understanding what you want to accomplish personally for yourself, and then finding a person. And sometimes people are not financially compatible.
Oh, that's a 100% fact.
And that's a real thing.
Yeah.
Right? And it's like, as a man, I'm old school and I believe in traditional roles per se, right? Look, women out earn us. Let's just keep it real. Like, that's just the way it is. But I still believe that you got to provide something, bro. You can't just be here not providing nothing, right? And whatever you're providing needs to be substantial enough that you can feel good as a man.
You got your ego stroke.
You have to be able to stroke your own ego.
Yeah,
pause.
yeah,
Like,
yeah.
It's like,
no, that's what I meant. You got your.
You got it. Like, and so like, it's important to understand your partner's. They talk about love languages. What are their
What are their financial languages? Did we just come up with
Hold
something?
Hold up.
What are their financial languages?
Hold up.
I like that.
I like that. We
that's
need to.
We're gonna put that over there, and we're gonna come back when the time is right.
Yeah. But
so
it's that though.
Okay, so when do you have this conversation? You meet someone. Is it when you're getting serious? Is it when you're dating? Is it when marriage? Because one thing that I did say about getting married is when you get married, you take on that person's everything.
Yeah.
Debt, everything. So one of my things about getting married was you watch me go through a 3-year process of fixing my credit from
So you better not mess your credit
500
up.
to 800, right? Yeah, and so getting married, I don't want to do anything and take on any unnecessary thing that's going to drop my, my credit score back down. And that's not saying that we can't get married until you fix your credit or nothing like that. That's not saying that. I'm just saying that
Those are things you think about.
those are things I think about, and that's part of the conversation.
I think the conversation, I don't think there's really a pinpoint time. I don't think you can get married without having that conversation.
Yeah, I definitely.
I don't think you can live
definitely
together
don't.
without having that conversation.
I don't.
So
I don't.
somewhere
Somewhere
around there is where you should be.
right before moving in.
Yeah, right before living together, I think that conversation needs to
Okay,
be had.
that makes sense. That makes
Oh,
sense.
you, kids.
Yeah,
So if kids come into the picture, that conversation needs to happen immediately.
yeah. So my situation was a little different. See, she was I guess it was a long-term relation, a long distance
Yeah.
relationship, and so
Yeah, but before that, y'all weren't financially tied
to
in
each
any
other,
way.
right?
Yeah.
So all of those having a child just had accelerated
That's what
the time that we needed to have these conversations. So
I just think that, man, money values, they don't even have to be the same. They just have to be understood and respected. That's the big thing, right?
Respected.
Respect how I feel about, like, me. One of my, like, big things is respect that I spent my money on something associated with you.
Mm-hmm.
You get what I'm saying? Like, that was a really big thing for me because I work hard for my money.
Right.
And my money doesn't come from a corporation. My money comes from my brain.
Right.
You get what I'm saying? And so
what you choose to spend
what I
money
choose
on,
to spend my money on, whether it's the right choice or wrong choice,
mm-hmm.
I made that choice. And so if I choose to spend my money on something associated with you because I love you, or I don't even want to say because I love you, maybe I'm just,
I wanted to do
maybe
it.
I just wanted to trick off or whatever. But for whatever reason, right, I made that choice to spend my money. Don't disrespect that. Don't disregard that. Understand, but that's very specific to me. Yeah. Some people,
yeah, no, I get it. I think
I'll get it back. I have that sometimes, but
yeah,
my I get it back takes a lot of.
I think the respect thing is definitely important, and you don't always have to agree, right?
Oh,
but
that is a good question.
The point of respecting someone's perspective is what's important.
I'm gonna throw one on there. What do you do? This is for the fellas though.
Mm-hmm.
What do you do when she makes more money than you?
I've never been in that situation, but I'm comfortable with not caring.
What do you do if she doesn't want to work and you can't afford it?
She got work.
But what if y'all building a life together?
You work to the point where I can afford it. Make sure at least you have a plan to say, look, this is what's going to happen to get me to where I want, so that you can, I can afford it.
Me and you are so different.
I'm gonna tell you.
Me and you are so different.
So Tuesday, she doesn't. She likes to work. She got goals and everything like that. But my idea is when I become an options trading millionaire.
Inshallah.
Right. It's already in the budget to
whatever she wants.
I
mean, whatever she wants to do.
It's already in the budget to have an allocated portion of the trading money go to her. Like, I'm already working that into the budget. So when it happens, it's like, look, every week, here's your payment, here's your stipend, here's your whatever you want to call it, your draw, whatever you want to call it. But this is your money. And if you choose to pay your bills with it, cool. If you choose to trick off with it, cool. But at least I'm providing something where you don't have to work. If you still want to work, fine.
So I have a 2-part feeling about that, right? Like, I'm okay with, like, if my lady doesn't want to work, right? But if we are building a life together and she doesn't want to work, then you have to help me build.
No, that's a fact.
You get what I'm saying?
That's 100% fact.
Like you have to contribute
Yeah.
to how we take care of all of
Yeah,
this.
you
You get what I'm
can't.
saying?
You can't be a detriment. And I gotta take care of this. And I gotta figure out how to continue to make the money roll in. Like it, all of that can't happen, and that's what can put a strain.
Yeah. I
on a
think, man,
relationship.
I don't think people talk about. I think it's one of those conversations that people try to avoid.
I think so too. And I think
that and credit.
I think credit is a big one.
I
You
think-
don't really know about somebody's credit until it's
Too
time
late.
to use it.
No,
or
it's too late.
Yeah.
Time to buy a house, time to buy a car, time
Yeah.
to.
Oh, how's your credit? Oh, I mean, you know. And then they get in this. That's a
Dang, you
500
got to
something.
start. Yo, let me see your credit karma on the.
Nah, I think that's a real thing. That's a real conversation to have. I wouldn't say the first or second date, but if y'all together, what's up, homie? You got credit cards? You got, especially for women asking these questions.
Yeah, women should ask men
You
these
got
questions.
you
yo.
got credit cards? What's your balance like? You don't have to know their score, but you know how you using your credit card? What you spending it on?
Yo, because you know what's interesting? Like I found that like in the dating space, like the conversation never is really like what's your savings look like or like.
Nah, it's not that.
It's always what you do, or
exactly.
you know what I'm saying. And they take what you do
and they process.
they
it
process
and think
your-
like, oh, okay, he's a doctor. You know,
little do they know he might make 500 a year, but he's
But he's
450 and
spending.
he
Yeah,
450 in debt.
these are some things. So I'm a drop a little gem, something that I learned from the job, right? Because you know, extracting data is what we have to do. So questions like this are data probing questions, but does it come off as data probing questions? So, for example, you want to know if ladies, you want to know if Buddy is saving. How much you save? How much of your check do you put away? He going, oh, what you mean? That right there lets you know he ain't saving ever. What you mean? Oh, $100, $50. Now you can take that. You can do your own math with it. Figure it out.
I'm such an ill dude. I'd have been like 30%.
Yeah, right. Right. But you can do that. But I mean, of course, she can fact check that as well. She know your salary and all that. But I'm just saying, like, these are some what's your highest credit card? What's your highest limit on your credit cards? That assumes that you have more than one, which means that you got good credit.
When do you think they should be asking these questions? If you ask me about my credit cards and freaking my savings on the first date, I'm never talking.
I don't think it should be on the first date.
I actually don't think they're date questions.
I don't think they're date questions.
Conversation questions.
I think it's you know them conversations where what's your favorite color?
When you put your feet on the wall.
Yeah.
When you in different positions on the car.
Slide one in there. Try to. What's your favorite color? Okay, all right, bet. Damn.
Yo,
how many accounts? How many savings you got? How many savings accounts you got? Or you can take
That's a good one.
Take a little back. Damn. Where you work at? They got 401. They got benefits.
You believe women save better than men?
Yes. I know that just from being in the hood. Women want to go on trip. They plan. They buy their trip off 6 months in advance.
Like
we wait 2 weeks. We know about the trip for 2 years. We wait 2 weeks.
These guys talk about South Africa. They start planning it. I'm like, that's too far away, bro. I ain't even thinking about.
I told our girl because between both families and our own personal friends and everything, it's like a whole bunch of vacations, right? And she like, look, we got to figure this out. And I'm like, look, I say yes.
And figure it out later.
I say yes to everything now, and I'll figure it out later.
That's a fact.
So we just different, man.
But again, that perfect segue, right? Because like that's planning for the future, right? And so you got your partner down pat, right? You got an understanding, but you can't project. Who projects? Like, let's say you had 500,000 at SVB,
right? You can't project that.
Who projects that?
You can't project.
You get what I'm saying? So how do you save yourself as a businessman and as an individual and the head of a family, how do you protect yourself or prepare for future disruptions, economic downturns, recessions, interest rates rising, all these things that we're hearing, a lot of these hot buttons are happening.
Yeah.
How does one like
Prepare for
all that?
So again, one, you should be knowledgeable, right? And if you're not knowledgeable or knowledgeable enough, you should hire someone who is knowledgeable, right? So that's the first thing. You don't always have to. Who I think Henry Ford said, I don't always have to know the smartest about everything. I just have to hire the smartest person
yeah.
about everything, right? So in that case, you should either know or you should hire someone. That's the first thing you should do. The second thing is that you should understand macroeconomics because you have to understand these hot topics right now.
Mm-hmm.
And then a lot of times there's already a built-in strategy, if you will, for things that you can do to mitigate the risk.
Okay. What does mitigate the risk mean for those who don't?
So mitigate risk means that you're going to limit as much risk as possible. You're trying to take away as much risk as possible because there's a thing called systematic risk, unsystematic risk, right? Systematic risk is things that can happen that's out of your control, that if it happens, everybody's going bad, right? For example, a systematic risk for everybody on Earth living is if a comet hits the Earth, right? That's a risk that we take every single day, right? So there's nothing we can do about a comet hitting the Earth. There's systematic risks that there's nothing that we can do about, but there are unsystematic risks, that things that if it happened, we could protect. So those things we need to protect as much as possible. For example, a company having 50% of their savings in one bank is not mitigating their risk, right? Because one, before the FDIC came out and said, what they said about returning all deposits,
and people would have lost a lot of money. They would have lost.
Somebody who had 500 million, the FDIC only insures 250,000. So it doesn't make sense to have that much money in that bank anyway, which goes back to why Giannis Antetokounmpo has
50.
He has his money spread out in 50 different banks, and he put 250K in each bank, right? I don't know if you've seen the email, but our bank, Mercury, they increased their insurance limit to $5 million.
Yeah, I did see that.
Yeah, so staying knowledgeable on things like that. For example, if you had, the bank that we have, you would know that, okay, we're insured more than 250,000, so maybe we can park, maybe not 5 million,
I don't think
maybe we could park 1 million. Yeah, maybe we could park 1 million in there instead of 250,000. So these are ways that you could just mitigate your risk. So in the stock market or in economics in general, when you have a downturn like a recession or higher interest rates, there are things or tools or commodities that have inverse effects. So this is just natural knowledge. So in a recession, gold increases, defensive stocks increases, consumer staples increases. These are just facts. Like it's not a strategy.
Yeah, it's not a strategy.
It's just
the way
fact,
it goes.
Right? When a recession hits, Kellogg brand goes up. Why? Because more people cutting down on spending astronomical money on going out and stuff. They're buying canned goods now, and they're stocking up on Campbell's soup. They're buying the cereal, which makes that company get more money. So this is like common sense things that, not common sense, but just factual things. That is understood. Once you understand it, you'll know that, okay, this is what you do to mitigate risk. These are some things that you can do to mitigate risk. Like
mitigating risk is what SVB did not do.
They did not mitigate risk at all. So those are some things, and that brings me to my next point, which Giannis do. This is perfect, which you want to diversify. So you want to mitigate risk, you want to diversify. For example, Giannis put his money in 50 different banks. One bank fell, you don't lose all the eggs in your basket. So it's all about diversifying. You can diversify across segments. You can diversify across markets. You can diversify across commodities. You could diversify even in a niche. You want to diversify in real estate. You could buy houses, and then you could buy
Apartment buildings.
apartment buildings. You know what I'm saying? So you could buy laundromats that go boom in a recession.
You can buy REITs.
You could buy REITs. So there's a lot of things that you could do in order to diversify, even if it's in one specific market segment. So you want to mitigate risk. You want to diversify. Those are the two things that you want to focus on in order to protect yourself from any financial downturn.
Sometimes people just are uncomfortable with someone else looking at their financial house, their financial setup, whatever.
Mm-hmm.
What are some things that they can do or some tools or some apps or whatever that you would recommend that they can just incorporate into, like, look, we all use Twitter, Facebook, Instagram,
Right. Okay.
Tidal, all those things. What's some stuff you're using?
Yeah. So in this new era of AI, there's a lot of things that's popping up in regards to making life easier. And in finance, it's the same thing. For example, you look at SoFi. SoFi actually stands for social financial, which means it wants to be like a social club around for money. Yeah. So it houses everything that you can think about to do with money. So if you want to talk about diversifying, you can open up a SoFi account, and you'll have access to
their whole menu of products.
Yeah, the whole menu of products. So if you want to move money from a broker account to a savings account, you can do that seamlessly. So that will be, something that I will look into.
I have a SoFi savings account.
There's a budget app called Copilot, and I haven't used it, but I've seen it and I've done a little research on it. It breaks down a lot of things as far as where's your money going, what you spend it on, how you can forecast, and different things like that. Even
use Acorns.
Acorns. That's a long-term savings account that you can have, something like that. I don't think that is restricted or tax deferred. I think it's actually taxed. But those are some things that you can use if you want to do it yourself. I'm not saying that these are the best options. I'm just saying that these are some options out here. As far as brokers, and if you want to invest but don't know how, you want to do it as hands off as possible, there's something outside of Acorns. There's something called M1, where you can set up your risk tolerance. You can set up what type of things you want to invest in, and then you could just invest a monthly payment in it or something, and it'll do it for you. There's people on the back end or whatever to manage your accounts and do all of these things. But one thing that I want to really talk about that really shapes the sphere of personal finance is there's an app called Currents.
What's that?
And Currents is basically the first line of defense for your money. So everyone talks about, pay yourself first, right?
Yes, that is a big thing.
The idea with Currents is you hook up all of your inflow accounts. You hook up all of your accounts.
All your income accounts.
Right, yeah. I mean, all your accounts, but you specifically want to hook up all your inflow accounts, all your income accounts. And what that does is it puts all your income comes in to this one account, Currents account. Then that Currents account takes all of that income and splits it up to where it needs to go. So you don't have to change anything. If you spend 10 months, if you spend 10,000 a month in, and your monthly expenses, you take all the income that comes in, and then you'll say, look, I need 10,000 a month to go to this account because this is where I pay all my bills at. Now you're left with the rest. And now you can actually see how much you're left with in that account. And then you can say, okay, of that, because 10,000 went out, of that, I want to invest such and such. I want to invest such and such. And what you don't do, and this is how much I want to take out because I want to spend. So you do all of that. You put in all your budget, your calculations, and what's left over, it just keeps growing up month after month after month until you set a goal. So if you set a goal for, I want to save 100K, you just hook this up.
Does it house the money?
It houses the money. No. I'm sorry. It don't house the money. The money is
in one of your savings accounts.
In one of the accounts. It's just letting you know how much is coming in. But over time, you're based off your budget allocation and everything, that money that's left in that bucket, it keeps piling up. And then once it piles up, they say, hey, you hit 100K. What do you want to do with it? Oh, I hit 100K, bet. I want to move 100K to my brokerage account. So it gives you a conscious effort of, what are you doing with your money? And that's why I like it so much. So those are some things that you can look at if you're into personal finance tools. If you don't want to hire, someone professionally, if you want to do it yourself, those are some tools that you can definitely look into. You got any? If
I've used Mint.
Mint, okay,
I love QuickBooks, but obviously just because I run a business.
right,
So QuickBooks does
a whole lot.
a whole lot,
Yeah.
but QuickBooks is very expensive.
Mm-hmm.
Um, Rocket has a money management product that I've heard good things about.
Rocket has Truebill.
Truebill,
So
yeah.
Rocket owns Truebill. I used Truebill before Rocket bought them, and basically what Truebill does is it just shows, all the subscriptions that you have or anything that you're paying for. So it cancels subscriptions if you don't have them. It finds all your wasted money and stuff like that. So that's I couldn't think of that, but that's something that I wanted to say as well.
I think that whatever, I mean, all these apps.
Yeah, I'm not gonna say they do the same thing. My
but
bad.
they don't do the same thing. But well, you know what, they do kind of.
Yeah.
There's a general goal there.
Mm-hmm.
I think the most important thing you can do, regardless of what app you use, is to increase your knowledge about
For a fact.
your money.
For a
right?
fact.
You shouldn't have any money coming in or going out and you not know where it is, where it's going, what it's paying for, that kind of thing. So I think whether you have a hire professional or not, if you have a hire professional, there should be monthly, quarterly updates on what's up with your money.
Yep.
But yeah, I just think, the tools are really, that's like really one of the first steps to like really taking control of your financial life is organization of it.
Mm-hmm.
And I think once you organize it, you can actually, it's easier to make it grow.
Yeah.
Well, I mean, that's kind of the end of our segments.
Mm-hmm.
How you feel about this coming week? What you think is gonna happen?
Man. So
what to watch for?
This week, I'm gonna tell y'all what to watch for. So Tuesday and Wednesday, we got FOMC meeting. That's basically Jerome Powell and his buddies. They get together, they decide what they're going to do with the market. If they're going to increase interest rates, decrease or pause. I don't see them decreasing anything. I don't see them pausing. Like I said earlier in the podcast, it was speculation that they would do a 0.5% interest rate hike. That was before the bank crashed. Then the bank crashed. Now they might do a 25. So we'll see about that. But that's definitely going to have an effect on mortgage rates, on bond rates. So if you got your money somewhere, just pay attention to that. And then also, First Republic Bank is on the verge of collapsing. There was about 13.
Somebody just gave them some money.
Yeah, there was about 13 banks that came together and essentially bailed them out. But they're not off the hook yet. So just watch out for that. It might be another bank that collapsed this week. If not, watch out for somebody buying them out. So those are pretty much the two biggest things that I got to look out for this week, man. You?
Well, obviously, Fed meeting.
Yeah.
That's really that's going to let me know what's going on. Real estate's a slow game, man. We're just in a slow period.
Yeah.
It's not really a lot of like big stuff going on consumer wise. I mean, the Fed is going to dictate really
a lot
what happens.
Yeah.
I want to introduce a new segment.
Live?
Yeah, I'm gonna do it right now.
So you heard it here first.
So every week I kind of want to give you like just a statement to leave with. You can call it your daily bread. You get it once a week from us or whatever.
Mm-hmm.
Just a quick little excerpt on just how to view money, something to take with you. So I have a book recommendation for everyone. If you haven't read it, it's called The Richest Man in Babylon. It's probably my favorite book I've ever read.
It's a good book.
It's an amazing book.
Yeah.
And It has 5 laws of money. They call it gold, obviously, talking ancient times, but 5 laws of money. The first law of money, I'm going to give to you guys today, is you acquire money by saving regularly, at least 10% of what you earn, to build wealth and secure the future. So that is my daily bread to you guys. Save at least 10% of your money every time you touch a dollar. If you touch a dollar, save 10 cents and continue to save it until you reach your goal, and then take that goal and invest in something that makes you interest on that money. So have a great day. I'm JFL Lee.
I'm Finance King.
This is the Bread Aisle.
Till
Shouts
next
out to
time.
Remy. Team up for excellence.
Disclaimer: the information provided on this podcast is for educational and informational purposes only and should not be considered as professional financial advice. Investing involves risk, and you should always do your own research and seek the advice of a licensed financial advisor before making any investment decision. The speakers do not guarantee the accuracy, completeness, timeliness, or reliability of any information discussed on this podcast. You agree that the speakers will not be liable for any investment decisions made based off the information provided on this podcast.